Hi, I'm Matimu Ngobeni, an actuarial specialist at Sanlam Corporate Investments. I'll be delivering an update on the third quarter global market performance and the macroeconomic factors that influenced the returns. Closer to the end of September, global markets were stirred by a possibility of a US government shutdown over failure to reach agreement on a spending bill. A 45-day extension was only agreed on the 30th of September. Meanwhile, in South Africa, there is a growing unease about a revenue shortfall compared to projections. As indicated by the tax collection data, the medium-term budget policy statement scheduled for release on November 1st is expected to provide clarity on how the government intends to address the increasing deficit. Local equity, measured by the All-Share Index, declined by 3.5% in the quarter, while global equity, measured by the MSCI ACWI, decreased by 3.7%. Bonds, traditionally seen as safe haven, couldn't shield investors from the equity market downturn as yield rose due to increased inflationary concerns and extended period of high interest rate. Local nominal bonds fell by 0.3% and global bonds were down by 3.1%. The worst hit asset class was global property, which saw a substantial decline of 6.1%. Cash was king in the third quarter, with South African cash yielding 2.1% in rands. Inflation-linked bonds yielded 0.8% as break-even inflation rate increased across the curve, and the rand appreciated by 0.3%. In the last 12 months, we observed positive returns across the board, with remarkable performance in riskier assets. Local property saw a robust increase of 12.9%, local equity surged by 17.7%, and global equity soared by 21.9%. Global property also posted respectable gain of 5.3%. In a high interest rate environment, local cash outperformed local bonds over the same 12-month period. Looking at the long-term performance, all asset classes displayed positive results, except for global bonds, which experienced a decline of 3.1% over the past 3 years, and local property, which decreased by 3.5% over the past 5 years. Local equity outperformed global equity in the last 3 years, while global equity emerged as the top performer over the past 5 to 10 years. Following OPEC Plus' decision to extend production cuts until the end of the year, the oil price surged. Concerns arise over the situation in the Middle East, particularly if the Israel and Hamas conflict expands to broader region, as it could further drive up oil prices. And the key question now is, how quickly can the conflict be brought under control? Central banks in several major economies maintain unchanged interest rates. The US Federal Reserve signaled that most members anticipate high interest rate to persist for an extended period. In contrast, the European Central Bank, the ECB, decided to raise interest rate for the 10th consecutive time with a 25 basis point increase to 4.5%. The ECB expressed the belief that those rates will substantially contribute to bringing inflation back to 2%, emphasizing that future decisions will be contingent on the data. Local inflation rose to 5.4% in September from 4.8% in August, bringing it to the same levels we saw in June. In its September meeting, the South African Reserve Bank kept the repo rate at 8.25%, but noted it might consider further rate tightening based on data. South Africa's GDP grew by 0.6% in the second quarter, though slightly below the peak experienced in quarter 3, 2022. The IMF raised South Africa's 2023 growth estimate to 0.9% and expect 1.8% growth in 2024. The global recovery remains slow, with the IMF forecasting a decline from 3.5% in 2022 to 3% in 2023 and 2.9% in 2024. Advanced economies are set to slow from 2.6% in 2022 to 1.5% in 2023 and 1.4% in 2024, while emerging and developing economies are projected to modestly decline from 4.1% to 4% in both 2023 and 2024. In summary, the equity markets encountered challenges as optimism dwindled and concerns regarding global economic outlook and high interest rate resurfaced. Brent oil prices surged by 27% in the third quarter due to OPEC production cuts. The global economic landscape remains uncertain, shaped by factors such as oil prices and major economic indicators. underscoring the need for vigilant monitoring to inform investment decisions.